Many business owners make money but don't actually understand their financial health. It is a common trap to look at a bank balance and assume the business is doing well, only to be surprised when there isn't enough cash left to cover a big bill or tax payments. This happens because a bank balance only shows what is there right now. It doesn't show the true story of how a business is performing. To understand if a business is actually making a profit, it is essential to look at one simple document. This breakdown of a profit and loss statement removes the guesswork and starts the process of knowing exactly how a business is performing. The simple definition. A profit and loss statement, often called a P&L or an income statement, is a financial report that summarizes revenues, costs, and expenses during a specific period of time. Usually, this period is a month, a quarter, or a full year. Its primary purpose is to answer the most basic question in business. Is the company profitable? Think of it as the story of business performance over time. While a bank balance is just a snapshot of a single moment, the P&L shows the journey from total sales all the way down to final profit. The final number is often called the bottom line because it appears on the very last line of the statements. If that bottom line is positive, well, congratulations, the business made a profit. If it is negative, it had a loss. Understanding this document shows if a business strategy is working or if changes are needed to grow. Revenue, the top line. The first part of any P&L statement starts at the very top. This is called revenue, or sometimes sales or turnover. This number represents the total amount of money a business generated from selling its products or services during the specific time period being reviewed. It is often called the top line because it is the very first entry on the statement. For example, if a business brings in $50,000 from sales, that $50,000 is the starting point for all the math that follows. However, revenue is just the beginning of the story. It shows how much money came in the door, but it does not show how much money is actually kept. A business can have very high revenue, but still be losing money if its costs are even higher. Revenue shows the total size of business activities before any costs are taken away. Costs of goods sold, COGS. The next section on a profit and loss statement is the cost of goods sold, or COGS. This section is very important because it lists all the direct costs that go into creating a product or providing a service. If a business sells physical products, COGS might include raw materials, the labor used to create them, and the cost of shipping. For a service-based business, COGS might look like the cost of contractors or specific software needed for a project. Essentially, these are the costs that go up every time a sale is made. If nothing is sold, these specific expenses do not exist. Understanding COGS is a key part of business reporting because it shows the cost of simply getting a product ready for the customer. Gross profit, the first reality check. Once revenue and direct costs are identified, gross profit can be calculated. This is the first major reality check for any business owner. The formula is simple: revenue minus cost of goods sold. This number shows how much money is left over from core business activities before paying for anything else like rent or marketing. It is a crucial metric because it shows if a pricing model is sustainable. If gross profit is too low, it means each sale barely covers the cost of the product itself. A healthy gross profit ensures there's enough money left over to pay for the background costs of running the business. Now, calculating these numbers by hand or using spreadsheets can be a major source of stress and wasted time. And that's why in today's video, I partnered with Xero. Xero is a global small business platform that provides smart tools for invoicing and cash flow insights. Instead of doing the math manually, Xero automates tasks like bank reconciliation and expense tracking. This platform is built to work with an accountant or bookkeeper, not replace them. When using Xero's reports dashboard, the software takes that data and automatically generates a profit and loss statement in real time. This means there's always an accurate, up-to-date picture of business health without the manual work. It's an easy-to-use tool designed to give back time to focus on growth. For those interested in trying it, there is an exclusive offer for you guys. The offer, as of the time of making this video, is 90% off for 6 months using the link in the description. Terms and conditions apply, so check the link below. Operating expenses, the overhead. After gross profit comes the section for operating expenses, often called OpEx or overhead. These are the background costs required to keep a business running, but unlike COGS, they are not directly tied to making a specific product or service. Common examples of operating expenses include rent for an office or storefronts, salaries and wages for staff who are not directly making products, marketing and advertising to help attract new customers, utilities like electricity and internet, insurance, and software subscriptions. These are costs that usually must be paid regardless of how many sales were made that month. Overhead is where profits often disappear. If revenue goes up but profit stays the same, checking operating expenses often reveals where money is leaking. Net profit, the bottom line. The final section of the P&L brings us to the most important number of all, net profit. This is the amount of money a business has earned after every single expense has been deducted from total revenue. It is located at the very end of the report, often called the bottom line. To find this number, take the operating income and subtract remaining costs like interest on loans or income taxes. If the final number is positive, the business was profitable for that period. If it is negative, it had a net loss. This number is the ultimate answer to the question, how did the business actually do? Understanding net profit helps determine if a business can afford to grow or if it needs to find ways to reduce costs. Analysis. A profit and loss statement is more than just a report card. It is a roadmap for the business. Checking these numbers regularly shows if a current strategy is working or if expenses need to be reduced to protect the bottom line. This clarity is where smart decisions come from and how a sense of control is built. To see a financial story automatically without the spreadsheets, check out Xero today. You can get 90% off for 6 months using the link in the description. Terms and conditions apply. Thank you so much for watching this video. I hope it was helpful, and I will see you in the next one.